Wow. We are once again live. Hello. Hello to all my VOD viewers. You're my favorite viewers. And only you will ever know that. Because there's only like 8 of you. Every single one of you are important and special to me. Today is going to be a fun day. It really is. Today's going to be a fun day. Today's kind of already off to kind of a weird start because of what happened over the weekend. We kind of had an interesting weekend, that's for sure. And by interesting weekend, I mean not much happened, not much to note, I think. Just a normal kind of chill weekend. No big news. No markets, they're not really reacting to anything. Amazon's up 3% though. Good for them. Bristol Myers Squibb's down 2. CrowdStrike's up 2. Wow. RXO is up 4.5. I wonder why. Let's look at the broader markets. The S&P is up 1. The Dow Jones is up 2. Why? Why are we doing this? Utilities is down 2. Why? All the emerging markets. Yo, I bet EM is exploding right now. Yeah, up 2%. We're gapping up in emerging markets. Seriously, this is insane. What a time! What a time! Listen, even Bitcoin is up. But Bitcoin typically follows the stock market. So that's somewhat unsurprising, I think. I'm still a bit sick. Listen. Woohoo. I've been getting a lot of my friends have been sending me I've been getting nonstop like Venezuela memes for the last, I don't know, like 3 days. It's insane, I think. My friends are having a good time of it. Meanwhile, who's having a really great time? Chevron. Yeah. Chevron's having a great time. Let's look at oil. Oil ETF. Give me a list of oil ETFs. USO. No, I don't want USO. I want an industry. XLE. No, that's energy. I want oil. IEO. NYSE. IEO. This must not hold a Chevron in it then. Anyway. The biggest winners today. Chevron's up 5%. Halliburton is up 10%. Exxon's up 2.5%. Regensa some bioscience company. QXO? What is QXO? Is this an RXO thing? Oh. Nah, they just got some investment. What is QXO? Beacon Building Products? Why do they name themselves QXO? What? Great heavens, what happened? They're up 20% today? Great heavens. I used to love Beacon. Beacon's getting acquired. My bet is on Lowe's. 100%. I would like to see QXO get acquired by Lowe's. Beacon Building Products is great. What happened? It happened in June. QXO June? That's how you spell that. 2024. What happened? In June 2024, QXO, formerly Silversun Technologies, officially launched, closing a $1 billion equity investment, rebranding and changing its NASDAQ ticker to QXO, with Brad Jacobs as CEO, aiming to become a tech leader in building products distribution through acquisitions. That didn't happen, by the way. What? Okay, I need to... QXO is a NASDAQ stock with a price that reached $290 in June and then fell to around $12 in early August. June, July, August. That's tough. Market cap went from 120 to 5. Okay, nobody lost 114, and the value was mostly a non-event because the June market capitalization was mostly meaningless. In this post, I'll explain my definition of meaningless. What? What? Okay, so this was just like some weird anomalous event. It doesn't really have any deeper meaning on anything. They still did terrible, I think. This doesn't have any impact on anything at all ever, I think. I don't know. This is something interesting to research, though. Anyway, QXO. What is QXO really Beacon Building Materials? I thought Beacon was a completely separate company. It is. It was acquired by QXO. Gotcha. That's tough. Beacon was such a good company. Anyway. Nvidia's down half a percent. Oh yeah, I forgot. Hang on. I4 Gore. No, I forgot to do. I always forget to do this. I hate how YouTube does this thing where every single time every single time that I do a new stream, the actual link to the chat resets. So I have to redo it over here. Anyway, so I cannot look at this. I'm gonna lose my mind if I do. Yeah. Some of our big winners, Chevron, obviously. Let's look at our top gainers. Big day for AeroVironment. Yo, we're at a great company. Highcroft Mining. I bet you anything, Highcroft has tons of assets in Venezuela. They're U.S. They're based in the U.S. Well, I don't really care. Why is I mean, I guess it makes sense. Mercado Libre is up 12. Everything in the emerging markets is up because regime change, I guess. Investors like regime change, I guess. Are there any like? Is there? Surely not. Ugh. Surely there's not a Venezuela ETF. Cred? That, oh, whatever. IBVC. Nope. All right. Yeah, Venezuela is not even a frontier market. They don't even have a market. Topgolf is up 8%. Yo, we're gonna start opening up Topgolfs in Venezuela. That's what's happening. Bullish? Why is there a company called Bullish? BLSH. What a great ticker. Bullish. It's a cryptocurrency company. Color me surprised. And they operated in the Cayman Islands? Oh my goodness. And their revenue is decreasing? Bro. Man. That's so crazy. They raised $1.1 billion. There really is a whole other world out there. Used to be called Blocked Out One. 164,000 bitcoins valued at $10 billion. Wow. They're headquartered in Georgetown, except that's in the Cayman Islands. What a great man. United Rentals? Anyway. Yeah, basically everything's up. Congratulations to the stock market and everybody that's invested. Cross country's up 6%. I'm almost break even on my investment, which is insane, by the way. This is my largest position. It is currently something like 25% of my portfolio. Why? Because I thought they'd get acquired. It turns out they did not. They did not get acquired, tragically. And I just kind of like held on to my position. I started buying around here. Bought a ton more here. Average price is like $9.50, so we're pretty close to break even. Only $1 away. Man, that's crazy. Why is everything up? Oh, regime change. Bro, what a stupid chart. What a stupid looking chart. 2021, by the way. All of a sudden you made congratulations on 5,000%, and then you lost 70, and now you're up another 150. Congrats, I guess. The people that bought at the very bottom, sold at the very top, bought again. Saw we. Congrats. Congrats to everybody that bought Regencell. The biggest winner, up 40% on the news that the United States is at war with Venezuela. So, we're going to jump right in, actually. We're going to jump right in. We're going to talk about Nike. We're going to move away from Venezuela. We're going to talk about Nike. Because this is something I've been researching over the last couple of days. I recently posted a video on talking about the dogs of the Dow. And by video I mean short. I did a short last night talking about the dogs of the Dow. If you didn't see it, the three biggest losers over the last year, the three worst performing stocks in the Dow Jones Industrial Average, are United Healthcare, Salesforce, and Nike. Of those companies, United Healthcare has a big mess to sort out. Salesforce has compelling products, but growth is slowing and investors are worried. And Nike has gotten beat up a lot recently for probably pretty fair reasons. Oh, all of this is gone. That's so tragic. What else did I have here? Revenue. Total revenues quarterly. Can I move this up? Whoa, there we go. We just need to get rid of off. Oh, on. Okay. So Nike's gotten beat up kind of a lot recently, and I think for pretty good reasons. So over the last 5 years, Nike's gone from a $280 billion market cap company to under $100 billion. So they've lost, 70% of their value over the last couple of years. Despite this fall, revenue is kind of weird. Revenue's been doing stuff. Revenue's been mostly flat to down over the last year. Full year, probably, let's do full year. Full year revenues are down. Although we haven't, done the entirety of this year. They're mostly flat to down. The biggest growth, we'll get into it a little bit later, but North America is where they're seeing the most revenue growth, and then China, they're seeing a massive fall off in revenue, despite the fact that that was one of the most important markets to the future growth of Nike. But we'll get into all that in a little bit. As of right now, revenues are not doing great. Of course, over the last couple of years. That being said, their price to earnings ratio has also kind of halved. We went from 85 to 37. So price is down 60%, price is down 70%-ish, and their earnings are not doing much better. So the price is falling, earnings are falling, revenue is not great. There's a whole big mess. So what happened? Nike announced in 2020 that they were going to get a new CEO. Nike replaced their longtime CEO, Mark Parker, who had been CEO since 2006. By the way, there's only ever been like 4 CEOs of Nike. The dude that founded the company, he, in like 1986, he left in 2006. He served for 20 years. Mark Parker served from 2006 to 2019. And then John Donahoe came in. Mr. Donahoe is, he was kind of the worst thing that ever happened to Nike. So one of the big things that Nike prided itself on was its sort of cultural relevance. But what unfortunately happened was Nike started to see a little bit of bloat happening in the company. There was a lot of bloat. Like, costs were there were high costs. There were probably more employees than maybe necessary, and there was and also we were heading into 2020. 2020 was kind of a big year for the whole digital space. And so what Nike decided to do was, hey, let's bring in a digital first CEO. And so John Donahoe is definitely that guy. If you don't know anything about John Donahoe, he was the CEO of Bain. Well, he was not the CEO of Bain Capital. He worked for Bain Capital for a while in the 90s. And then he eventually, as a managing director from 92 to 99, or from 99 to 2005. Yeah, the worldwide managing director of Bain Co. from 99 to 2005. If you don't know anything about Bain & Co., private equity, they like to, you know what they do. They cut costs, and they cut costs hard. Eventually, he became the CEO of eBay, which, honestly, his tenure at eBay worked out pretty well. He was able to cut costs and drive revenue growth. The whole digital transformation worked great at eBay. And then he went to ServiceNow. Again, I'm fairly certain. Yeah. And then he went to ServiceNow, which again, ServiceNow is an entirely internet native platform. And he went to ServiceNow, and ServiceNow, they're publicly traded, right? I know they are. Yeah. So his tenure at ServiceNow saw massive growth in the stock price, right? So 2016 to 2020, he did great. The stock is up 500% over his tenure. He did great. ServiceNow is a software company. They do cloud computing, right? Super simple. Great. Come in. Dude comes in. He has one job: cut costs and get people on platform. Get people on platform. Bring in new users, right? Great. All right. Awesome. The problem is, this does not work for Nike. Nike is not a digital platform company, but the board of directors thought they could be. Nike fundamentally is entirely reliant on their network of partner stores. People go shoe shopping. They don't care about. They care less and less about brand. They're caring more and more, but they don't necessarily care about brands specifically. The average consumer, right? There are all sorts of people that are very defensive over it. I am one of these people. To be clear, I am. For shoes, I buy Hoka's, right? I'm a Hoka fan. I like Hoka's. They're great. Them and Brooks, right? I defend my interest in these companies. But regardless, Nike decided that they were going to bring in John Donahoe because they wanted to drive e-commerce. They wanted to create a good D2C brand, right? They wanted to cut costs. They wanted to cut out the middleman, their partner stores, and they wanted to focus on digital growth. And this happened in 2019. This was right before the pandemic. This was prime time, right? The problem is Nike does not support this. This is not the way you run Nike. Nike is a cultural phenomenon. It's not a digital markets thing. And so there's a really interesting article written by Forbes, sort of in the wake of this. So basically, this is exactly what he did. Donahoe slashed sales teams in R&D and shifted products from Nike's retail partners to its own stores. Unsurprisingly, this boosted numbers in the short term. Soon after he took over as CEO, Nike struck gold when it revived a low-top sneaker from the 1980s with a black and white color scheme known as the Panda Dunk. Donahoe's reorganization of Nike followed a similar trajectory. He laid off hundreds of marketers with an intimate knowledge of Nike's customers, intending to replace them with data-driven insights. Product creation shifted from sports to demographics. This is something that we were reading about a couple of days ago. Demographics, not the best thing in the world, but we'll get into that later. Instead of a department focused on creating products for basketball, it would have one creating products for men, like Zara, Gap, H&M, and other generic fashion brands. His shift from wholesale marketing through retailers to direct sales through Nike stores yielded market share to competitors who used that new presence to establish themselves as peers to the legendary swoosh. The result was, from the words of the former Nike branding executive Massimo, I'm not going to try and pronounce his last name, For the first time in Nike history, long-term vision wasn't about sustainable growth anymore. It was about the supremacy of D2C led by digital, period. Unsurprisingly to anyone who knows the shoe market, but shockingly to Nike's new leadership, many customers, mainly occasional buyers, did not follow Nike, but continued shopping where they were shopping before. So, once they could not find Nike in their stores because Nike wasn't serving their stores any longer, they simply opted for other brands. And Nike's financial performance soon became so bad that on June 28th, the release of Nike's earnings report triggered a 28% slide in the company's stock price, its worst single day of performance since its IPO in 1980. Donahoe, inevitably, responded with layoffs. Of course, the natural reaction. There were, after all, no innovative new products that can turn the tide. Perhaps worst of all, Nike's powerful aura of cool, the one that made it inseparable in the public mind from athletes like Michael Jordan and LeBron James, was so shattered that GQ asked, "Is Nike still cool?" And finally, on September 19th, Nike's board finally stepped in. Wisely, they decided, Nike's board finally woke up. They were asleep at the wheel. They were completely asleep at the wheel. And they finally woke up. And they said, we need a change. And so they brought in Mr. Elliott Hill. If you don't know who Mr. Elliott Hill is, he is the president and CEO of Nike right now. He has worked at the company for 32 years. In senior leadership positions all across Europe and North America. And he was responsible for helping grow the business to more than $39 billion. $39 billion. He retired in 2020. But the GOAT, the king, he was brought back in. They said, we need you, sir. Please run our company. Clearly, we do not know what is best for it. And he did. And so what he has done is he has implemented a turnaround plan for the company. It's going to be slow. It's going to be arduous. We're about a year into it. So like I said, I had this somewhere. Where did it go? Maybe I got rid of it. I must have gotten rid of it. Let's pull it up again. The board of directors announced that Elliott Hill will become CEO and Chief Executive Officer of Nike effective October 14th, 2024. He will also be the director of Nike. I'm excited to welcome Elliott back to Nike, given our needs for the future, the past performance of the business, and after conducting a thoughtful succession process, the board concluded it was clear Elliott's global expertise, leadership style, and deep understanding of our industry and partners, paired with his passion for sport, our brands, products, consumers, athletes, and employees, make him the right person to lead Nike's next stage of growth. Personally, I have worked with Elliott for more than 30 years, and I look forward to supporting him. The king, he has returned. One of the greatest leaders of Nike has returned to the building. Regardless, the problems do not stop there. The problems are merely starting at Nike. They have a long hill to climb. Nike sales fall 12% in Q4. This is from June 26th to 2025, so the middle of last year. Nike is not out of the woods yet, but CEO Elliott Hill expressed the worst is behind it after an extended sales slump for the sneaker giant. This sales slump continues. Reported sales fell 12% year over year in the fourth quarter to $11.1 billion, Nike said on Thursday, a smaller drop than analysts anticipated and better than Hill's own estimates last quarter that tariffs could drag down sales by the mid-teens in quarter four. Shares rose 2% in after-hours trading on the earnings announcement. Net income has shrunk in the past year to $211 million compared to $1.5 billion in 2024. This is This is important. This is what turnaround looks like, right? I Over the last couple of years, I've actually pretty much ever since I started investing, I've had sort of a special fascination with turnaround companies. One of the big, I made a video on this a couple of years back. One of the big companies that I bet a lot on was a company called Bed Bath & Beyond. I bet that Bed Bath & Beyond would be able to figure themselves out. I bet that the new CEO that was coming in, he was going to lead cost cuttings, and this is something that this is how you find out. These are the lessons that you learn in investing. I really believe that when the new Bed Bath & Beyond CEO came in and he was like, okay, we're going to cut costs, we're going to build out our brands, and we're going to refocus on our stores and then also on digital transformation. Literally the exact same thing that John Donahoe was brought in to do to Nike. What happened was so interesting because the exact same thing happened at Bed Bath & Beyond that happened at Nike, where it worked really well in the beginning. You saw profit there because there's this giant pull forward of profit and revenue, right? There's a turnaround plan. They're revitalizing the business. They're spending a ton of money early on to do all these different things. They're trying all these different things. They're bringing in a lot of customers because they're spending a ton of money. And everything looks great on paper. Maybe they even go back and they buy back shares. Maybe they start paying a dividend or whatever. In Bed Bath & Beyond's case, they did all of this. And for the first year or so, things were looking pretty well. Revenue increased, I think, by something like 12 to 15%. It was like growing double digits for the first year or so. Like it was very impressive. The turnaround plan was very impressive. The problem is that they just, Bed Bath & Beyond especially, they just couldn't continue the momentum. The amount of money that they were spending was way more than they had, and eventually their debt caught up with them. And I made a profit off of Bed Bath & Beyond. I think I tripled. That was a triple on my investment. And the reason was I got super lucky because it became a meme stock, right? Along with like Costs and GameStop and AMC. It got caught up in all those companies, and Bed Bath & Beyond was like, it's saved. And so the company, tripled over the next couple of days. And so I sold everything because I saw the writing on the wall, right? Bed Bath & Beyond was like, yeah, our revenue's up, but our profit is falling, and we don't know if we can continue this momentum into the future. And it turns out they just couldn't. And so what happens is, after the fall, you have to do this, and this is the hard thing to do, right? I tell that entire story to say this. Net income has shrunk in the past year to $211 million from 1.5. The reason why they lost $1.3 billion in net income is because they have to do product development. Their innovation is completely gone. It got completely gutted by the last CEO. The innovation of Nike, completely gone. And that's just what you get when you do cost cutting, right? If you do cost cutting and you're like, we're going to focus on our key lines, and we're going to do cost cutting and we're going to save money, and we're not going to, be the sort of like nimble company that we once were. We want to like be a mature company. What ultimately happens, especially in these culturally important companies, which I would say Nike very much so is, or at least was, eventually it catches up with you. And that's why, if you go back to here, John Donahoe took over like right around when the revenue was $45 billion. When he left, revenue was 51, right? That looks really impressive. But again, this is all just pull forward, right? They're pulling forward all of their goodwill, but they're not able to sustain it because they've cut out what fundamentally makes their business good. And they did that through cost cutting. Now, granted, you can do cost cutting in effective ways. But you cannot bring in someone new, especially someone who's unfamiliar with a business, in order to do cost cutting, because you get stuff like this. There's a big pull forward, and then you just can't sustain it because, oh yeah, you're turning around, you're spending a ton of money, but all of a sudden that you're gonna have to spend the money later anyway. Anyway, so important note: net income has shrunk $1.3 billion because they have to. They have to do product development. They have to do innovation, marketing efforts. They have to rebuild those relationships. Right. This is the other really important thing. Both Nike's, we're going to look at this later, both Nike's direct channels and wholesale revenue fell in the fourth quarter. Direct sales were down 14% to $4.4 billion, while wholesale fell 9% to $6.4 billion. Again, this is the middle of last year, but this is one of the big problems. This is one of the big problems that they're running into, right? Nike brought in the new CEO, and as part of cost cutting, they decided we're going to cut off all of our partners, and instead we're going to try and sell direct to the consumer. We're going to sell through our stores, and we're going to sell online. And so now, once all of that hasn't worked, now they have to now Nike's forced to go back to those partners and try and rebuild those relationships. Yeah, for 2025 fiscal year ending May 31st, sales were $46 billion, down 10%. While our financial results are in line with expectations, they are not where we want them to be. Moving forward, we expect the business to improve as a result of the progress we're making through our Win Now actions, Hill said in a statement. As we enter a new fiscal year, we are turning the page, and the next step is aligning our teams to lead with sport through what we are calling sport offense. This will accelerate our Win Now actions to reposition our business for future growth. Win Now is the name of the thing that Mr. Hill is doing. Win Now is the brand rehabilitation strategy Hill put in place after the former Nike veteran took over as CEO. Win Now is the brand rehabilitation strategy Hill put in place after the former Nike veteran took over from CEO John Donahoe in September last year. Win Now recenters Nike's focus on sports and athletes, an innovative currently underway in Paris, where the brand hosted Breaking 4 programming and related product teasers around Faith Kipyegon's first female runner to break a 4-minute mile. Wait, what? Hang on. Surely this has happened before. No woman has officially run a 4-minute mile yet, but Faith Kipyegon came close with an unofficial attempt running a personal best of 4:07. Wow. What's the mile record? The mile record is 3:43. Fascinating. Anyway, slight tangent. Interesting tangent. But yeah. So another thing that didn't really help Nike was the whole tariff thing at the beginning of last year. While Hill warned of potential tariff threats in third quarter earnings, the impact of lingering trade policy changes remains to be seen as the Trump administration's new tariff rates remain on pause until July. Anyway, we saw all this. But yeah, so basically, Nike dug itself into a hole by appointing John Donahoe as CEO. Nike dug itself into a hole by appointing John Donahoe as CEO because John Donahoe came in and he did what he did at every other company he's ever worked at, which is cut costs and, core business model stuff. This does not work for Nike. Nike is a culturally relevant brand, and their brand image is almost as important as their partners. And so once you cut off the partners that sell your products, it turns out you don't sell as many products. Anyway, And so what has happened in the wake of what's happened in the wake of Nike's sort of abandon, and so we read this a little bit ago. What's happened in the wake of Nike's abandonment of, actually, I don't know if I want to use this shot. And so we've seen what's happened in the wake of Nike's in the wake of Nike's abandonment of its fundamental businesses, of its fundamental business structure, and its abandonment of its selling partners. We've seen other brands rise up in its place, right? We've seen On Running come up. We've seen companies like Brooks and who are the other? Deckers. Deckers has great brands. This is exactly why Nike just isn't winning. This is exactly why. Can I get just this? Yo, that's a tiny picture. That's crazy. Hang on. Oh, this is a real. I just want a list of these running shoe brands. Yo, I wonder what that looks like now. The most popular sneaker brands. I wonder if there's a chart for 2025. This is from March of 2024. Okay. There we go. So in the vacuum left by Nike, other brands have sort of, these aren't even whatever. This is one thing I did not think about. Saucony, bro. That's crazy. Saucony is such a good brand now. They were so bad. Anyway, um, we'll do something. Anyway, um, there was a hole left by Nike. And so what happened was when they cut off sort of all of their partners and they pushed into this, when they cut off all their distribution partners and they pushed into this sort of new space, what ultimately ended up happening was that there were other brands that came in and took that space. So you have the really big running companies now. You have like On, you have Saucony, you have Brooks, there's Hoka, which is one of my personal favorites. You have all of these different running shoe companies that are also coming up, and they're just making good shoes. Asics, for instance, is doing tremendously well. Who owns Asics? Who owns Asics? Is Asics its own company? Yeah, Asics is its own company. Oh, you know what would look really good? This is what I'll do. Price change, and then we'll add on is a big one. Oh, I know. And then Asics is doing really well. Asics Corporation. What's another like running brand? Who owns Brooks? Berkshire Hathaway owns Brooks. Oh yeah, I knew that. Deckers brands. Deckers does Uggs and Hokas. Yeah. Okay. Deckers Corporation. What? All right. I'm such a professional, guys. Deckers. And what was the last one? Deckers, On, and Asics. Look at Asics. It's crazy. Okay. So can I make this full screen? Give me full screen. Yeah, okay. Good enough. So I wish I could move this. So like I was saying, Nike cut off all of its partners and started to do its own, started to do its own thing. They started to sell directly through their own stores. They wanted to do online only. They wanted to, sell direct to the consumer. And so what happened was it allowed all of these other shoe companies to start coming up behind them and compete with them. And so over the last couple of years, you could see this right here. This is the share price performance of a bunch of different other running companies, running shoe companies. And you can see they're all wildly outperforming Nike, right? So Nike's down here, negative 46% over the last 5 years. Let's do over the last 5 years. Even more insane, Nike's fallen 54% over the last 5 years. On Running, which obviously owns the On brand, they're up 41%. Deckers, which owns Uggs and Hoka's, they're up 130%. And Asics, which is just like a shoe brand at this point, they don't even really, they do running shoes obviously, but they do just like normal everyday wearing shoes as well. They're up 430%. And so this falling asleep at the wheel has cost Nike dearly, not only in share price performance, but it's allowed competitors to come in and they've stolen that cultural relevance, which I don't know that Nike can get back. And if they can get it back, they're going to have to fight incredibly hard to do so. Now, obviously, Nike is not like strictly a running shoe brand, right? And so comparing them to other running companies is not necessarily the best comparison in the world. But at the end of the day, Nike sells shoes. And so if these other companies are able to like walk through the door that Nike's left open, and they're able to diversify outside into the sort of more culturally relevant areas that Nike was once able to occupy, well, then Nike might not do so well in the future. And I do think in some capacity, ASICS is sort of becoming that company. I don't think that they will ever be like a Nike. I don't think they're ever going to have like an Air Force One or like a Jordans. But ASICS is becoming, I see these shoes literally everywhere. Now, again, that might be my own personal experience. But I think that they are an incredibly well-run company at this point. And the stock price has reflected that reality. And so Nike has a lot. And so again, talking about this sort of like culturally relevant loss, and this is what Nike sacrificed with John Donahoe. They've already lost it. They've already lost the cultural war at this point. It's incumbent on Nike to win that again, because it doesn't matter how cheap your stock price is. If your company, especially a company like Nike, if it just can't remain culturally relevant, it doesn't matter. There's no like path forward in Nike's future that sees them coming back from this unless they can obtain cultural relevance again. And so if you look through the actual like earnings statements of Nike, you see sort of where the big problems are. Revenue's down, revenue's up 1%, so basically flat in the last 3 months. Let's zoom in. Zoom. 6 months ended, again, 1%. Cost of sales has gone up, so their costs are, so like I said, costs are rising. You have to do this. You have to spend on R&D. You have to get the cultural relevance back. Current assets, they have a lot. They're, like I said, they're spending a lot. They're hoping, they're betting the whole farm. That's what they're doing. And this is where you can see what is going on. North America, total $5.6 billion. The change is up 9%, right? So their North American business is growing pretty well. Europe, Middle East and Africa, only up 3%, $3.3 billion, the second largest portion of their business. And here's the big kicker. What is this? 11:30? Yeah, this was most recent. Europe, Middle East, and Africa. And here's the big kicker. Greater China. Accounting for only $1.4 billion worth of revenue, but it was one of their fastest growing consumer segments. Revenue's down 17%. Down 13% in the last 6 months, but 17%. With footwear collapsing 21% and apparel collapsing another 6%. And then also, if you go throughout the rest of Asia Pacific and Latin America, you see another negative 4%. The total Nike brand is, generally unchanged. Converse has seen like a collapse as well, negative 30% in sales, just brutal stuff. Global brand division is down 31%, most of which is Converse, just crushing. Business Insider ran a story about Nike is struggling to stay culturally relevant in China. Let's find out why. Nike sales in Greater China fell 17% in the most recent quarter, which we just looked at. Nike's CEO acknowledged the slump, saying it needs to reset its approach in China. Experts say Nike is struggling with cultural relevance as the local brands connect with young consumers. Again, this is what happens. Nike's grip on China's sneaker market is slipping. Once a status symbol among Chinese consumers, analysts say it's increasingly losing cultural relevance, even as its products remain innovative. The sportswear giant's stock tumbled by 9% in early trading on Friday after reporting its Q2 fiscal results on Thursday. While sales in North America rose 9% to $5.6 billion, sales in Greater China were down 17% to $1.42 billion. We just looked at that. The core problem is a systemic cultural lag, Linda Yu, general manager of consultancy firm Red Ant Asia, told Business Insider. Nike needs to move beyond traditional sports marketing and genuinely understand and integrate into the cultural confidence, sense, and community belonging and lifestyle aspirations of China's younger generation, she said. Chinese consumers, particularly Gen Z, are embracing Guochao movement. Are embracing another cultural movement that celebrates Chinese heritage and homegrown brands. Local brands such as Anta and Li Ning have been capitalizing on this by creating culturally relevant marketing campaigns, product designs, and digital experiences that resonate with younger consumers. Nike's messaging, which still leans heavily on elite athleticism and individual grit, with slogans like its iconic "Just Do It," feels distant by comparison. And this, by the way, is the commercial director at China Marketing Strategy Tong Global. Not great. Of course, the geopolitical tensions between the U.S. and China are also making it harder for Nike, encouraging consumers to favor domestic competitors. I think that Nike has failed to adapt the cultural values of China's Gen Z, he said. He said, some observe while Nike's content is high quality, it feels less authentic and more brand controlled, making it less accessible for a generation who crave personalization and self-expression. Rivals such as Lululemon and Adidas have seen growth in China as they've found ways to connect with shoppers there. So clearly, American companies are able to come in and be somewhat culturally relevant in China. Nike just isn't able to do that. And I think the ultimate irony of this is, Nike is also playing catch up when it comes to digital engagement. The digital engagement transformation CEO dude, John Donahoe, he just wasn't able to do it. And so, like I said, Nike has a lot of problems right now. Sorry. I just want to quickly read through this shareholder letter, see if I can find. This is the shareholder letter for 2025. This is what the CEO, Elliot Hill, this is his sort of first shareholder letter. And this is what he's telling his people. This is what he's saying, like, this is what we want our brand to be. When I returned to Nike this fiscal year, I did so because I have what is called an irrational love for this company. I've been a part of the Nike family for over 30 years and take incredible pride in what the brand stands for, to bring inspiration and innovation to every athlete in the world. Inviting 8 billion athletes into the world of sport is a uniquely powerful purpose that drives me and my teammates every single day. From my first day back, it was clear to me that we need to get back to putting the athlete at the center of everything we do, because athletes have always been the fuel of our brand. I also knew that we would have to make some immediate moves to focus our teams. We landed on what we would call our win now actions across culture, product marketing, marketplace, and ground game, with a sharp focus on 5 key sports, 3 countries, and 5 key cities. We want to ignite our winning culture, shape our brand for distinction, and accelerate our product portfolio, running, basketball, and global football. They want to elevate and grow the marketplace, and they want to win on the ground. They want to get back with these authentic relationships with consumers in the neighborhoods where they live and play, getting back together with their distribution partners. And obviously, we can see that over the last couple of years, you can see the performance, right? Revenue performance is starting to slump. Earnings per share has completely collapsed. Return on invested capital has already started collapsing and has collapsed even further. And then the stock price obviously follows. And this brings us to kind of like today. We kind of already saw this, but this is Elliot Hill talking about the most recent quarter's performance. Nike is in the middle innings of our comeback. We are making progress in the areas we prioritize first and remain confident in the actions we're taking to drive the long-term growth and profitability of our brands, said Elliot Hill. Fiscal 26 continues to be a year of taking action through Win Now, including realigning our teams, strengthening partner relations, rebalancing our portfolio, and winning on the ground. And we saw all of this, right? We looked through this. So they're sort of in the middle innings. Nike also saw, I'll also pull up SEC Form 4, and then we'll take a look at NKE. Also recently, Nike was in the news for something interesting that happened. Something interesting that happened with the brand. A very prominent director at Nike and also the CEO, Elliot Hill himself, both made major buys of the company's stock. As you can see, one of the directors, also known as Tim Cook, also known as Tim Apple, the CEO of Apple, purchased about $3 million worth of Nike stock. And Elliot Hill himself also bought about $1 million worth of Nike stock. Tim Cook buying about 50,000 shares and Elliot Hill buying about 16,000 shares. So you have the CEO of Apple and the CEO of Nike itself both spending tremendous amounts of money to buy shares personally. And on this news, Nike climbed quite a bit. Nike shares climbed 4% on Wednesday after insiders picked up the stock near the end of a rough year. Apple CEO Tim Cook, who serves as a director at the athletic apparel maker, added around 50,000 Nike shares, and he basically doubled the amount of shares that he had. Fellow board member Robert Swan bought 8,700 shares. Another board member, Robert Swan, also bought 8,700 shares, which was about 25% more shares than he had. And of course, Nike's CEO, Elliot Hill, got about 16,400 shares verified in a transaction valued at about $1 million. His personal stake grew by more than 7%. He owns a lot of shares. Good Lord. And so that's sort of where we're at today. Nike has a long way to go, but they've come a long way. The actions that the CEO is taking, I think are good. They're good first steps. The problem is that Nike has a lot of like foundational problems, right? Should you invest in Nike? Simple question. Hard to answer. I'm thinking it might be worth taking a small stake in Nike. And I might add it to the portfolio. We'll think about that. I might add it to my portfolio. The reason why I'm thinking very heavily about adding Nike to my portfolio is pretty simple. Nike, it seems as though they finally sort of woken up, or at least in some capacity that they have. The board of directors finally realized that Nike is not eBay or ServiceNow. They realize that they're not a digital-first platform. They realize that the partners are really what makes the brand, and they're the most important part. And so they brought back Elliot Hill, who for 32 years has worked at the company, and they've implemented this turnaround strategy. Now, typically, turnaround strategies don't go so well, but typically, turnaround strategies are not done by, 30-year veterans of the company. And so it gives me some faith, especially considering, you also have the CEO of Apple on the board of directors at Nike. And so with Tim Cook probably stepping down in the new year, it would be interesting to see if he sort of takes a more active role in Nike moving forward. I somewhat doubt it, but there's always the possibility. But Elliot Hill, I think, is the right man for the job. I think the changes that he's making are good. I think refocusing on the things that make Nike good and what established Nike as the brand that it was, with the prestige and honor and aura that it had. I think Elliot Hill is best. I think he recognizes that, and he's the best man to turn the company around. Now, as for whether this will all work, that remains to be seen. But hey, you know what? I think no matter what, Nike's going to be an interesting company to follow over the next couple of years. That's absolutely for sure. Because they're back in the fight. That's for, and they've, like I said, they've got a long hill to climb. This competition, this isn't just going away, right? And they have to figure out, and Nike has to figure out how to deal with this competition. And I don't know that they're going to be able to do that. But hey, you know what? Nike's an interesting company to follow, no matter what. Nike also pays a dividend, I think. Their dividend yields 2.5%. Crazy stuff. But anyway, if you enjoy this video, be sure to subscribe. Also like. Come hang out live too. One of the things I kind of want to do is I want to like put a subscribe thing in the middle of a video. I just don't know how I want to do it. Yeah. So that's Nike. That's the basics of Nike. Delete the group. Goodbye, Nike. Goodbye, Nike. What is happening? Tech revives in the wake of Venezuela. Apple stock is down. That's so tough. The CEO of CrowdStrike spent $300 million to become a partial owner of the Mercedes F1 team. Good for him. He's a technical advisor with them. What? The CEO is getting distracted. Like, I get it. CrowdStrike is doing really, really well. But good lord. Is Mercedes publicly traded? They are. MBGYY. OGC, obviously. But they're flat over the last, like, decade or so. Good. Good stuff. I don't like seeing companies like, I don't like seeing CEOs like this. What is, actually, what's his net worth? $8 billion. Wow, good for him. George Kurtz, $8 billion. How much CrowdStrike does he own? Does he have to sell any? Yeah, he's been basically nonstop selling, which is pretty cool. Um, they've sold $1.2 billion worth of stock. You know what? This is not a this is not a good chart. This is not good. No, none of the insiders are buying. Everybody is selling. They're running for the doors. That's crazy. I guess get you a bag, but like, good lord, George Kurtz. Wow. Kurtz Family Dynasty Trust. What a great name. Let's find out. He owns 2.1 million shares of CrowdStrike. His current price like 500, 450. It's only like $1 billion. Where's all this money come from? Yeah, it's only $1 billion. Where's the other 7 coming from? Also, insane. He won his class in Le Mans 6 years ago at the age of 49. What is happening? Does Total Wolf own 1/3 of all of Mercedes? Surely not. Yeah, 1.6. Okay. How is Toto Wolf worth like a third of what Kurtz is worth? What is? I don't understand. Anyway, um, neither here nor there. George Kurtz, incredible stuff. Good for him. Getting that bag. I want to go back. I want to look at my portfolio again. Intel's flat. I think the hype is starting to cool down, which is nice. Very very nice to see. Beyond Meat's up too. They're up to 90 cents. They're almost $1 again. Amazing. Let me go buy another 1,000 shares. What's my current largest positions? No. Yeah, whatever. Total value $4. Oh, I have like point like one of a SCHC share. Um, Currently my largest FRDM is my crazy. So my largest position is still CCRN at what percent of my portfolio? It's like 10% of my portfolio, but of like invested cash, it's like 25% of my portfolio. So cross country healthcare is like 25% of my portfolio. Number 2 is FRDM at 11%. For a very long time, it was Intel at 10.5%. My third largest position is Beyond Meat at 8%. 8% of my portfolio is Beyond Meat. And then we got CVS at a whopping 8% as well. 8.1% to be. Oh no, is UiPath. UiPath is 8%, and then it's BND at 5, and then CVS at 5.5. Yeah. So CCRN's at 25% of my portfolio still, and it's growing. It's now at it's like 27.8%. That's crazy. Good for that guy though. Only down 10% on his investment. I think it might be worth selling FRDM. I think we've gotten very overvalued. We've gotten very overvalued at FRDM. Despite the fact that I literally just made a video on it talking about how incredible and amazing it is. I have a feeling it's not gonna do so well in the future. Yep. Is FRDM a good ETF? Who knows? It has outperformed EEM, XEV, XEC, VEE, and ZEM by 10 to 20%. Incredible. It's almost like Berthol was right. Berthol was right. And so was I. Everybody should have bought it. It's too late now. Mercado Libre. Hasta Mochado. you should never react to news. Um, this might be a good short. I want to bring this up. Investors Business Daily. You should not listen to these people. Oh, they're not making any strong claims, which is cool. Is there anyone making strong claims? Yeah. So no one's making. Of course, none of these news outlets are going to make strong claims. But energy stocks rise on hopes Trump will tap Venezuela's vast oil reserves. You should not bet on this happening. This is not good investing. The good investing would have been to go out and buy all of these energy stocks like 2 weeks ago. So obviously you see a lot of the big energy stocks like Chevron, ExxonMobil, Halliburton, all these companies like soaring today because of regime change in Venezuela. You should not buy stocks in reaction to all the investors that are listening to this, especially this is the day of it opening. You should not go out and buy oil stocks based off of the news that Donald Trump has basically said that we're going to run the country. This is not good. This is not a good idea. All of this is already baked in, right? All of you know what? Chevron is up 6%. The market, it knows now, right? The competitive advantage is gone. I doubt very highly that Chevron will benefit substantially from this. They may. I somewhat doubt it. Maybe Trump does, even if Trump does, eventually we're going to have to leave Venezuela. And so we're not going to run the country forever. The oil companies that are benefiting massively today, the oil companies that are jumping today, just because they might have like some future in Venezuela for a little bit, like Chevron, ExxonMobil, Valero, Phillips, Marathon, the Halliburton, all these companies, Schlumberger, Halliburton, all these, they're not gonna Repsol. See, like Repsol maybe, right, because they're already an established player in the region. If anything, when we get like a new regime in there, when we install our own little puppet government that's friendly to the United States, the existing natural oil and natural gas companies are going to come in, and they're probably going to be the ones to run the things. Chevron, ExxonMobil are probably not going to benefit materially over the next couple of years from regime change in Venezuela. And I would venture a guess even further that the vast majority of the stocks that are benefiting today will probably go down tomorrow. I would not be surprised. Especially if the president comes out and if the president comes out and does any sort of like formal outline of what they're going to do in the region, that it's over, right? Unless he appoints like ExxonMobil as like the king of Venezuela, it's probably not gonna benefit tremendously. Although, hey, you never know. U.S. oil stocks jump Monday because Venezuela owes a lot of these the country of Venezuela owes ConocoPhillips more than $8 billion, and Exxon is still owed $1 billion. You might get some negotiation where ConocoPhillips or ExxonMobil gets some percentage of gets some stake in Venezuelan oil fields for the next couple of years in order to repay that debt. You never know. Again, I find it to be somewhat unlikely. Also, Chevron is already there, right? They do 20% of the country's. They already produce about 20% of the country's oil, and that's probably why Chevron is up the most of any of the big oil companies, right? Chevron, CVX. Chevron is a $300 billion company, up 6% on the news that the country that they are already exporting 20% of the oil from is now they might be able to export a little bit more. It's like, you know what? They're up 20, like they gained $20 billion in market cap today just for I don't think very good reasons. But yeah, I stand by this. You should not go out and invest in Venezuela. You should not go out and invest in oil stocks just because Venezuela regime change. You're not going to see it. And even if ExxonMobil gets appointed as the king of Venezuela, you're not going to see the returns on that for years, right? Oil companies are slow moving. They're not these like nimble companies that can come in and like take over immediately. These are slow moving massive operations that it would take it'd probably take like a multi-decade plan in order for any company to make any sort of meaningful difference in the country. So the incumbents are going to win. Chevron, whatever. Although I will say Venezuela is sitting on one of the largest crude deposits in the entirety of the entire world. So not the best thing in the world. Please don't trade on news. If you already own Chevron, now is a great time to sell. That's all I'm gonna say. It is not a great time to be buying because you're about to be exit liquidity for other people. Yo, GM is the top automaker in the U.S. again. Let's go. My king. The king's back. Accusing the acts of hegemonic acts, of course, is to abide by international law and stop violating other countries' sovereignty and security. Based. Trump reportedly brushed off the chances of his move rupturing relations between the world's two largest economies. Hugo Chavez was 2007? I feel like he was like the 80s. That's crazy. Yo, he looks old. Good lord. But yeah. Yo. Manufacturing is collapsing in the United States. Color me surprised. U.S. manufacturing activity shrank in December by the most since 2024, capping a rough year for American factories. The Institute for Supply Management's manufacturing index edged down to 47.9 from 48.2, according to data released Monday. The measure has been below 50, which indicates contraction for 10 straight months. Wow. U.S. manufacturing continued to shrink at the end of 2025. Plus, materials costs remain elevated. The ISM Prices Paid Index, which held at 58.5 last month, is 6 points higher than it was at the end of 2024. So, well, I guess that sort of makes sense. As the price of goods and services, as the price of raw materials, as your price of inputs go up, your outputs typically go down. It's kind of like basic supply and demand economics, so U.S. manufacturing remained in contraction mode for most of 2025, and today's report does not indicate a turnaround anytime soon. Wow. It's almost like when you stop manufacturing. It's almost like when you stop subsidizing manufacturing, manufacturing tends to stop. That's crazy. Who would do such a thing? What absolute moron would do such a thing as to stop subsidizing manufacturing? It falls unexpectedly, bro. We stopped subsidizing manufacturing. It's not unexpected. This is like obvious, I think. Copper hits 13,000 a ton. That's crazy. What's the price of copper? Price of copper. Dog. What is happening? Time to cover your vents, I guess. Let's find out why this ETF cannot. Government Grift ETF. GRFT. That's such an incredible. What an incredible ETF. The Government Grift ETF. Connecticut-based Tuttle Capital Management recently pitched an ETF built around a provocative premise that political influence itself can be an investable signal. The firm's proposed Government Grift ETF, with the proposed ticker GRFT, aims to invest in companies perceived to benefit from their proximity to Washington decision-makers. From cabinet officials to members of Congress whose stock trades attract scrutiny. The problem? Nobody wants to list it. Of course not. I think grift implies that people are doing something wrong, Tuttle Capital CEO Matthew Tuttle recently told Bloomberg. The investment philosophy is awesome. We are looking for unusual congressional trades. Grift's snub is notable given how permissive the regulatory landscape has been. Leveraged single stock ETFs, crypto-linked funds, and strategies tied to ultra-short-term options exploded last year, benefiting from a regulatory posture that loosened during the second Trump administration. Tuttle himself has been a regular contributor to that trend, filing for leveraged funds tied to Bitcoin and mega-cap tech names. Tidal Financial has also filed for two ETFs. The Subversive Democratic Trading ETF and its Republican counterpart, GOP, track securities bought by Democratic and Republican members of Congress, respectively. It's using an ETF wrapper to unpack how our members of Congress are investing their money and what patterns exist across these funds. I think that this is just hilarious, and I think the Nasdaq and the New York Stock Exchange should just chill and they should lift it. I think having a government grift ETF is a great idea. I think it's a great idea. I think we should do it. What? Trump is launching ETFs, dude. Trump is launching ETFs. TSSD? Oh my god. Oh my goodness. Goodness. Ladies and gentlemen, the President of the United States of America has his own ETF. You can buy it. In fact, he has 5. Who's underwriting these ETFs? I want to short their company into the ground. Trump Media and Yorkville American Equities. Darn, they're a small company. It tumbled 5% on the announcement. That's so tough to win. Cringe. Truth Social Funds invest in the Patriot economy. Cringe. America First Investing built for modern portfolios. Cringe. Truth Social American Red State REITs ETF. This is so stupid. This is monumentally dumb. Red State REITs ETF. What a stupid idea. Can I get a holdings? Give me a holdings. What does it own? Vici, Broadstone, NNN. Oh, nice. Realty Income, Four Corners, NetsREIT. American Energy Sector Security ETF. What is this? What does this mean? All of the big, whatever. Next Frontiers. Oh, it's a micro cap fund. What's the benchmark? I need a prospectus on this. Oh, yo, the operating fund expenses is 0.65. He's charging so much money. Dog, what are you talking about? Why are we doing schizophrenia in our investing? Why are we doing this? The fund seeks to replicate before fees and indexes the performance of the Truth Social Yorkville. You know what? I'm going to do a whole video on this. I'm going to do some research on this, and I'm going to do a whole video on this. The 1792 exchange is in. Wait, what? What do you mean 1792 exchange? What is this? I don't know what this is. I don't know if I want to go on this website. Exposing bias to help America's businesses get back to business. Cringe. Pro bono services. Good for them. The 1792 Exchange is a nonprofit organization that publishes information regarding corporate policies and the practices. It is corporate bias risk. Wow. Cancellation. Yo. This is crazy. Non-business causes? I don't even know what to say about this. This is crazy. This is like psychosis, I think. Oh, yeah, it's all the same thing. American Icons ETF. What do they do? TSIC. Let's look at let's look. Yeah, I get it. Don't worry. I understand. That's what I'm saying is this is where's TSIC? Truth Social, American Icons, Home Depot, Netflix, Walmart, Costco. Yo, Netflix, aren't they the DEI company? Why are they here? Pepsi, McDonald's. I thought they were all DEI companies. Procter and Gamble, Lowe's, Altria. Altria? Hello? They're like Altria is like the staple child of ESG investing. What are you talking about? Yikes. So you can, I guess you can invest in Donald Trump's ETFs. You shouldn't. That's a bad idea, but you can. Um, yeah. Why Maturo's ouster will have limited impact on gas prices. Um, what a crazy. Man, Novo Nordisk really is struggling. They're just not doing well. Coursera. Mercado Libre. Do 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 do. Cool stuff. Give me one a moment. Momentum. Very important in the new year. Wow. Momentum is very important. Downward momentum, upward momentum, both very important things. Both things to pay attention to. It seems like a lot of the big AI companies sort of have downward momentum moving into the new year, which is not great. They're off their highs, not, well, that's year to date, never mind. They're off their highs, not significantly, but like, kind of like a lot. Yeah, what's crazy, bro, I'm telling you, that's what's so crazy. I made a sort of a joking video about this, but this is literally Oracle's chart, or this is literally Cisco's chart. Right? Massive run up, massive fall. I don't know if Oracle's worth the buy, you know? Its PE is only 36. Its PE was only in the 70s? Bro, this is my kind of stock. Good lord. Well, it was my kind of stock like a couple of years ago. Like, it was 63. This would have been a PE of like 12. How low? That's crazy. I should have bought some Oracle stock a bunch of years ago. Well, I should have bought Bitcoin like 40 years ago, but I wasn't alive. So, how's MP Materials doing? Of course, they're up 5%. Hey, remember when the United States government took a 10% stake in the company for no apparent reason? And the company went up like 200% on that news? Remember that? I remember. Weird stuff. Weird stuff. Just kind of strange stuff. I do not know. It's so funny, dude. Truth Social. Ugh. What a terrible name to have your Four-Dimensional Therapeutics. Apparently, they're not going to be able to sell anything to Venezuela because they're down 3%. Same thing. We can't sell all our weed to Venezuela. They're down. I think I still own some Kenvu shares. It rose quite a... Yeah, see, it recovered. That's what I was saying. It's been mostly flat, though. How's KMB doing? Kimberly-Clark is the acquirer. They're not doing so well. They might be worth looking into. 5% dividend yield. Good lord. Kimberly-Clark might be worth looking into now. Under 100? It's a pretty good price. Yo, why is Tesla up 4%? What are they going to sell cars to Venezuela? Good lord. Either way. Shell eyes return to Venezuela to claim gas billions. Shell is down 0.62 on the news. A slow day. TSMC up 2%. I'm surprised they're not up more. I figured they would be able to sell more chips to Venezuela now. I gotta stop making this joke. It's old and tired already. Well, the worst performing stocks of 2025. Interesting. The Trade Desk, Fiserv, and Deckers. Gartner and Strategy. Gartner is just random IoT stuff, right? What? They're a consult. Oh, IT management. Interesting. Dude, they were like 700 a share. That's crazy. How long ago was that? November. Interesting. Ubiquity, I need to look into. How big is this company? 34 billion already. Crazy. Are these guys just like losing to AI or something? Why are they? Yo, you really do hate to see it. Oh, what happened? What did they? August 1st. Gartner, August 1st. Second quarter earnings. No. Gartner predicts 40% of enterprise apps will feature task-specific AI agents by 2026, up from less than 5%. Well, looks like they're betting on their own downfall. Not ideal. Give me Gartner IR. Give me investor relations. Show me Q2. Up 6%. Why did they fall? Wait, when was this? Of course they're not going to say it. August 5th. So this is what they fell. Oh, are they just not doing? Okay. Gene Hall, the CEO, second quarter revenue, adjusted EBITDA, adjusted EPS, and free cash flow were ahead of expectations. Contract value grew 5%. Since the end of the first quarter, we've accelerated our stock buybacks to increase shareholder value as we continue to roll out Ask Gartner, our new AI-powered tool that provides faster access. What? Why did they fall 30%? Revenues are increasing. Huh? Gartner. The future of research under the risk of AI. I'm going to be honest. Rating downgraded as growth outlook disappoints. That's why. Weakness fully priced into its stock price. Upgrades to buy. I don't think I don't think AI is going to displace a enterprise level research firm in the next couple of years. This is November. I don't really... Take me back. Gartner Q2. Darn. Oh well. Gartner prices, yeah. I mean, fair value estimate of $60. Fair enough. Fiserv, 72%. This is the payments company, right? Yeah. Fintech. And then Deckers is the consumer cyclical. That's UGG and Hoka, for those who may not know. And then, of course, MicroStrategy. Bitcoin hasn't had the best year. Man, I missed the boat on Seagate, too. It's so tragic. Look at 300, bro. I need to just start buying companies that I think look good. I need to just start buying them. You know, I did not care about Western Digital. I cared about Seagate. Seagate and SanDisk. Two massive regrets. Can't win them all though. The Trade Desk. I made a whole video on why I think the Trade Desk is worth looking into. Fiserv, I don't think anyone can help them. Deckers Outdoor, great brands. You're in the middle of a consumer cyclical. They're consumer cyclical. We're in the middle of a consumer crunch. It makes sense why they're one of the worst performing stocks of the year. Gartner IT, people are scared that they're going to get replaced with AI research. I heavily doubt it. They do enterprise. Gartner does enterprise level research, right? They're not going to get displaced by AI. And MicroStrategy, that sucks. It's Bitcoin. No one cares. You shouldn't buy it anyway. But yeah, the Trade Desk, it's just a good solid company. They operate in areas where there isn't a ton of competition. People are really wary that Amazon's going to come in and try and like take out the Trade Desk or like eat a significant portion of the revenue. I just don't see the argument panning out. Just doesn't make any sense to me. Trade Desk doesn't compete with Amazon on platform. Amazon doesn't compete with Trade Desk off platform. I just don't see it. Fiserv, I forget what the big thing for them was, but they had a bad year because they had like a bad earnings reported or whatever. What was it? Softened growth in Argentina and difficulty balancing long-term and short-term projects, the payments firm CEO said this week. So they just kind of have a mess. Every company faces that challenge. Not every company goes down 70%. Yeah, not every company does this in a year. Tough way to go. So the Trade Desk, good. Fiserv has a lot of struggles. I just don't think their CEO really has a clear vision for what they want to do in the future. Deckers Outdoor, great brands. We're in the middle of a consumer crunch. Hey, it happens. Might be worth taking a look into. Again, solid brands. Gartner, they're not going to get displaced by AI. They do enterprise level business research. It just doesn't make any sense. And strategy, it's Bitcoin. Obviously, it's trash. And those are the worst performing stocks of 2020. Those are the worst performing stocks of 2025. I think they might perform a little bit better next year. Look at that. Look at that chart. Just tragic. Not great. AECOM. What is AECOM? What does these guys do? They're up 3%. They're down a lot. What do they do? American multinational infrastructure consulting firm. They do infrastructure consulting. What? They fell 30% on what? What news? November? Must be a recent earnings call. Why AECOM was plummeting this week? The stock of AECOM, which specializes in infrastructure, go away. Motley Fool. In infrastructure construction. I swear. Motley Fool. No more pop-ups. Or else I'm leaving. Infrastructure consulting, construction, consulting, and services has not been looking all that sturdy lately. Amazing writing. Just not a good company. AECOM. What do they do? Investors. Give me... Yo. This is a terrible website. Corporate releases. Give me quarterly results. Presentation. When was this? Delivered 6% growth for a full year, highlighted by 9% growth in the Americas in the fourth quarter. Net leverage is less than 1. Good for them. And they've cut their shares outstanding by 30 million. Wow. This can't be a very big company, right? I didn't actually see. 13 billion? They're for S&P 500, I think. What was the big deal? What was I forget. I literally just read this. Have dementia. Specializes in infrastructure consulting, construction consulting, and services. Has not been looking all that sturdy. The company busted. Oh, it's just slowing growth. Like 22% on slowing growth. Consensus estimate. They do more revenue than they have market cap. They do like their market cap and earnings. Amazing. Oh, never mind. 2%. The death of the 2% death. Unfortunate. Relegated to GDP plus 0. Unfortunate. GDP plus 0 is not the place you want to be. That's for sure. Anyway, I am a head off for now. Thanks everyone so much for hanging out. It's been fun. It was fun. Fun hanging out. Fun looking at the stuff. See what's going on. I have so much stuff to research now. None of these stuff like super interesting. I kind of want to do a coupon video. I definitely want to do those new Truth Social ETFs. That seems such such a fun rabbit hole to dive down. So that'll definitely be the next big thing. But until then, that's gonna be it for now. Thanks for hanging out, and until next time, peace out.